They said the American dream was unstoppable. They said the markets would rise forever. They said if you just invested, if you just believed, wealth was guaranteed. But what if I told you that almost overnight that dream collapsed? And that the very system designed to build generational wealth became the machine that erased it? This isn't just the story of a market crash. It's the story of how trust, greed, and delusion came together to destroy fortunes that took decades to build. It's the story of how Wall Street erased generational wealth, and why, even today, the same warning signs are flashing again. The 1920s were a decade of promise. America had survived World War I, industries were booming, and cities were expanding faster than ever. Electric lights, automobiles, radios, the symbols of modern life filled the landscape. And with them came a powerful belief that the stock market wasn't just a place for the rich. It was the new path to the American dream. By the mid-1920s, millions of ordinary Americans were investing. Factory workers, teachers, farmers, all putting their savings into stocks. Because why not? Prices kept rising, and newspapers ran stories of average people becoming millionaires overnight. But behind the optimism, a dangerous illusion was forming. A market that looked unstoppable was being fueled by something unsustainable: debt. Let's rewind to understand how it all began. After World War I, the U.S. emerged as the world's new economic powerhouse. European economies were rebuilding, and American banks became the lenders of the world. Interest rates were low, credit was easy, and the Federal Reserve, only a few years old, was still learning how to control monetary policy. The banks encouraged investment, but not just with savings, with leverage. Buying on margin became the new gold rush. Here's how it worked. You could buy $10,000 worth of stock with only $1,000 of your own money. The rest, borrowed. As long as the market kept rising, you made enormous profits. But if prices fell, even slightly, you could lose everything, including what you borrowed. And Wall Street knew this, but the frenzy was too profitable to stop. Brokers, banks, and corporations were all in on it, manipulating stock prices through pools, coordinated groups of investors who secretly agreed to inflate prices and then sell to unsuspecting buyers. The illusion of endless growth was spreading, and no one wanted to question it. By 1927, the market wasn't just booming, it was euphoric. The Dow Jones Industrial Average nearly doubled in 2 years. President Calvin Coolidge famously said, "The business of America is business," and Americans took that literally. Companies expanded aggressively. Real estate prices in Florida soared to absurd levels as people bought land they'd never even seen. Everyone wanted a piece of the action. Magazines published stories of the new financial aristocrats, people who'd gone from rags to riches through smart stock picks. One of them, Jesse Livermore, was a Wall Street legend, the boy plunger who made millions by timing markets. He symbolized the dream that anyone could beat the system. But for every Livermore, there were thousands of silent average investors, saving, borrowing, and trusting. They didn't see the cracks forming beneath the surface. It started quietly. In early September 1929, a few financial insiders began selling their shares. The economy, they noticed, was slowing. Steel production was down, car sales were dipping, and corporate profits weren't keeping up with stock prices. But most investors ignored the warning signs. Then came Thursday, October 24th, Black Thursday. Stocks opened lower and panic began. Crowds gathered outside the New York Stock Exchange as ticker tapes fell behind, unable to keep up with the chaos. Banks and major financiers rushed in to reassure the public. They bought huge blocks of stocks to stop the fall. And, for a moment, it worked. The market stabilized. But then came Black Monday and Black Tuesday, October 28th and 29th. In just 2 days, more than 25% of the market's value vanished. $30 billion evaporated, an amount greater than the total cost of World War I for the United States. People who had believed they were building wealth discovered they were actually building debt. Those who bought on margin faced ruin. Their brokers demanded repayment, forcing even more selling, and prices spiraled down further. The dream was over, and for millions, the nightmare was only beginning. The market crash didn't cause the Great Depression on its own, but it was the trigger that exposed everything wrong beneath the surface. Banks failed by the thousands, farmers lost their land, businesses shut down, and unemployment, which had been around 3%, exploded to nearly 25% by 1933. Imagine 1 in every 4 people you know being out of work. Families burned their furniture for heat. Children went hungry. Entire towns turned into Hoovervilles, makeshift camps named after President Herbert Hoover, whom many blamed for doing too little too late. And the wealth that had taken generations to build? Gone. Homes were repossessed. Savings accounts were wiped out when banks closed their doors. The very institutions people trusted to secure their futures had betrayed them. At first, the government's response only made things worse. The Federal Reserve, worried about speculation, raised interest rates, choking off credit right when the economy needed it most. The Smoot-Hawley tariff of 1930 slapped taxes on foreign goods, prompting other countries to retaliate, crushing global trade. Each attempt to protect America only deepened the crisis. President Hoover believed the economy would fix itself. He urged patience, confidence, and voluntary cooperation from businesses. But confidence was gone. As banks failed, people hoarded cash, pulling money out of circulation. And the less people spent, the more companies collapsed. It was a downward spiral with no bottom in sight. In 1933, Franklin Delano Roosevelt took office with a promise, a New Deal for the American people. He immediately declared a bank holiday, closing all banks to stop the panic. Then, one by one, they were inspected and reopened only if they were solvent. Next came sweeping reforms. The Glass-Steagall Act separated commercial banking from investment banking, ending the conflict of interest that let banks gamble with depositor money. The FDIC was born, guaranteeing deposits so people would never again lose everything if a bank failed. The Securities and Exchange Commission, SEC, was established to regulate Wall Street and prevent the manipulation that had fueled the bubble. Slowly, confidence returned. Jobs programs, infrastructure projects, and social safety nets helped rebuild the foundation of the economy. But the scars were permanent. An entire generation's dreams of wealth and stability had been erased, not by bad luck, but by a system built on greed, speculation, and illusion. For decades, the Great Depression shaped how Americans thought about money. People saved more, borrowed less, and distrusted risky investments. Banks were tightly regulated, and Wall Street was forced to operate within limits. But time dulls memory. By the 1980s and 1990s, the old restraints began to erode. Financial deregulation, once unthinkable, returned under the promise of innovation and growth. Glass-Steagall was weakened, then repealed entirely in 1999. Complex financial products like derivatives and mortgage-backed securities flooded the market. And once again, people believed the same old story, that markets always rise, that risk could be managed, that this time was different. It wasn't. Fast forward to 2008. Banks had bundled risky home loans into securities they claimed were safe. Credit default swaps, financial bets on whether those loans would fail, created a global web of leverage and illusion. When the housing market collapsed, the system unraveled. Lehman Brothers, once one of the oldest investment banks on Wall Street, imploded. Trillions in global wealth disappeared almost overnight. Sound familiar? The same forces of speculation, leverage, and blind faith that defined the 1920s had returned, only now multiplied by technology and globalization. And once again, ordinary people paid the price. Retirement accounts vanished, homes were foreclosed, generational wealth was wiped out. In the aftermath, bailouts and stimulus plans stabilized the system, but they also revealed a deeper truth. The financial world had learned to survive its own mistakes, while the public was left to start over. So here's the question. If the lessons of the Great Depression were supposed to prevent another collapse, why do we keep repeating them? Because the mechanisms change, but human
behavior doesn't. In the 1920s, it was stocks. In the 2000s, it was housing. Today, it's everything. Tech stocks, cryptocurrencies, real estate bubbles, even speculative AI investments. We live in an era where the illusion of endless growth has returned stronger than ever. People are once again told that markets only go up, that debt is opportunity, and that wealth is just one smart trade away. And yet, under the surface, the same warning signs are flashing. Rising inequality, record household debt, overvalued assets, and fragile confidence. The average American household now has less than $5,000 in savings, while the top 1% control more than 30% of all wealth. History is whispering, but are we listening? First, wealth built on speculation is not real wealth. When money chases itself instead of creating value, collapse is inevitable. Generational wealth isn't built overnight. It's built on discipline, savings, and resilience. Second, the system rewards risk until it doesn't. Wall Street thrives on cycles of boom and bust because someone always profits from both. Understanding where you stand in that cycle, as a borrower, an investor, or a saver, is the difference between surviving and being erased. Third, history doesn't repeat, but it rhymes. Every financial collapse carries the same DNA: greed, leverage, and the belief that this time is different. It never is. The Great Depression wasn't just an economic event. It was a psychological one, a collective reckoning with the limits of human optimism. We like to believe that technology, regulation, or data will save us from the next crash. But history shows that what really drives collapse isn't algorithms or interest rates. It's emotion, greed, fear, and the need to belong to the winning side. So the real question isn't if another financial reckoning will come. It's when, and who will be left holding the illusion when it does. Because every generation has its own version of the Great Depression, and every time it starts the same way, with people believing the dream is too big to fail. The Great Depression erased trillions in wealth and reshaped the world economy. But its greatest tragedy wasn't just the money lost. It was the trust broken. Trust in banks, trust in markets, trust in the idea that playing by the rules guarantees success. Today, we stand at another crossroads, one defined by record highs, digital speculation, and the same blind confidence that once preceded disaster. The past is not just a story, it's a mirror. And if we dare to look closely, we might see that the reflection hasn't changed much at all. So the next time someone tells you that the market only goes up, remember what happened the last time everyone believed that. If you learned something from this story, or if it made you question what you thought you knew about money, then hit subscribe, because we're just getting started. The history of finance is not a story of numbers. It's a story of people. And the next chapter? That's being written right now.